Kenya may soon be forced to pay higher interest for loans it takes from external borrowers following the withdrawal of the International Monetary Fund's 100 billion shilling standby credit facility. That is one of the major downsides of the IMF's latest move, even though overall it is not expected to adversely impact citizens directly. Here's Victor Kiprop with an analysis of what the latest development between the National Treasury and the IMF means for the Kenyan economy.
Thursday's announcement that the National Treasury had failed to renew the 100 billion shilling standby credit facility with the International Monetary Fund (IMF) may have injected some measure of uncertainty into the Kenyan economy. Analysts now say the long-term impact of not securing another credit facility may be even bigger.
When they remove that facility, it means that to the creditors, and the market signal is that we are not as credit-worthy as we think. So creditors at some point will look at us in a different position as previously when we have a facility. So if we go for a third Eurobond, is that most likely we will get high interest rates.
Withdrawal of the facility leaves foreign reserves as the only buffer available for the Central Bank of Kenya to cushion the shilling from external shocks such as increased imports and mounting pressure to repay foreign debt. The decision to renew the IMF's standby credit facility may dent the country's perception among current and potential investors.
The other option is that because we are biggest importers and most of the imports come from China, you can try and trade with China using the yuan. But we have limited options. My appeal will be that to Treasury that they should look away find a way in how you can negotiate with the IMF.
Beneficiaries of IMF's standby credit facility such as Kenya are supposed to meet a set of requirements that include cutting back on fiscal deficits and maintaining inflation levels within a set target range.
It's more of when you take a loan, when you take a car, and there is an insurance side of it. So it just covers that if in case of anything, you can access those funds for any eventuality. You can access and use to stabilize your currency.
Kenya's foreign reserves, the amount of money it can use to tackle sudden economic shocks, currently stands at $8.57 billion US, equivalent to 5.71 months of import cover and well above the minimum recommended 4 months. The withdrawal of the IMF's credit facility may not have an adverse impact on the economy at present, but it points to a soaring relationship between the Bretton Woods institution and the Treasury, which would do well if expeditiously addressed. Victor Kiprop, NTV Business.